South Korean chipmaker SKhainic's controls nearly two-thirds of the global high-bandwidth memory chips, locking into NVIDIA's AI revolution. That dominance means the company now accounts for 28% of South Korea's entire KOSPI market index. So when that index suddenly plunged 10% recently, the resulting shockwave quickly triggered a frantic tech stock sell-off around the globe. But analysts investigating the drop found something strange. This plunge was artificially amplified by an automated financial machine. The momentum of the AI boom now rests on a financial architecture with a specific hidden vulnerability. The source of that vulnerability sits in Hong Kong. It's called the CSOP SKhainic's Leveraged ETF, and its original purpose was entirely straightforward: to track the chipmaker's stock and offer investors a way to bet on its growth. But as artificial intelligence hype flooded the market, this specific fund ballooned out of control. In just 9 months, it swelled into a $13 billion financial behemoth. To understand the scale, look at this chart comparing daily trading volume. This small, stable bar is the value of SKhainic shares that actually change hands on a normal day. This massive secondary bar represents the ETF, holding over $13 billion in assets. That makes it twice the size of the underlying trading volume. Among large stocks tracked by leveraged funds, this is the most extreme ratio anywhere in the world. A financial mirror has grown so large and heavy that it is now physically moving the object it was designed to reflect. The core promise of any 2x leveraged ETF is simple. If a stock goes up 1%, the fund guarantees its investors a 2% return, calculated fresh every single day. To artificially manufacture that double return, the fund relies on a sprawling network of major Wall Street banks. These banks provide financial contracts called swaps, and they hedge their own exposure by buying exotic insurance policies known as cliquettes. But that daily promise contains a mechanical flaw. Because the math resets every afternoon, the fund has to execute massive mandatory trades to rebalance its books. Visualize it like this flowchart. A rising stock forces the ETF to buy shares, pushing the stock higher, repeating the loop. It creates a predictable wave of buying on up days and mandatory selling on down days. Human traders have figured this out. Every day around 1:30 p.m., day traders in Hong Kong completely ignore SKhainic's actual business fundamentals. Instead, they buy shares early just to front-run the ETF's robotic afternoon buying spree, taking the easy money before the market closes. SKhainic's minute-by-minute valuation is no longer dictating the behavior of the fund. The fund's algorithmic schedule is dictating the valuation of SKhainic. On highly volatile days, this single fund and its smaller peers can account for 2/3 of all trading volume in SKhainic shares. That volume is beginning to choke the Wall Street banks, who are forced to facilitate these trades and hedge against the daily swings. We can see that strain in the data. These are cliquettes, specialized derivatives banks buy to protect against a sharp stock collapse. In just a few months, the annualized cost of this downside protection spiked from a baseline of 3% to more than 10%. Providing the necessary financial swaps is becoming increasingly expensive. Banks are now hitting their strict internal risk limits, and the ETF's managers have warned that they might have to suspend the creation of new shares entirely. The financial machinery supporting the AI boom is reaching the limit of what its counterparties can safely handle. As long as tech stocks keep climbing, this mechanical loop acts as a virtuous cycle. It generates profits for the banks structuring the trades, the hedge funds providing the insurance, and the retail traders riding the wave. Take Ron Ding, a 26-year-old retail investor who poured his savings into the fund. His profits were so immense that he was able to buy a luxury Patek Philippe Nautilus watch. But the focus on algorithmic gains has obscured the fragility of the underlying asset. When that upward momentum eventually breaks, the machine is blind, and it will execute its programming in reverse. A tumbling stock price will force the ETF into mechanical selling. That sell-off will tank the stock's price further, triggering yet another mandatory wave of selling. This threat isn't isolated. Regulators are approving copycat ETFs globally, swelling the leveraged fund industry to a potential $270 billion of concentrated risk. SKhainic serves as a warning sign. It proves that the AI revolution is heavily reliant on a financial alchemy that could turn a standard market correction into a high-speed crash.